Okay, so as I mentioned earlier, so our topic for today is about derivative securities. No? So again, when we say derivative security, this will be a financial contract between two parties for buying or selling a property, assets, commodity, or other security at a predetermined price within a specific time period. So generally, a derivative security is a contract representing a group of underlying assets. So the most common underlying assets are bonds, no, stocks, commodities, currencies, market index, and interest rates. So the value of derivative security is derived from a dependent, of course, no, a dependent on the performance of underlying asset or a group of assets. So these underlying assets are traded, no, separately from the derivatives. So derivative securities include future contracts, forward contract, options, and swap, and other variants of this, such as synthetic collateralized debt, no, obligations, and credit default swaps. So these derivatives are used of hedging and gaining leverage. So one telltale characteristics of derivatives security is that it does not securitize actual assets, no, like a mortgage backed or other asset backed security. It commoditize a contingency that is related to the underlying asset rather than actual monetizing the underlying asset. So actually, no, the derivative security, again, as I mentioned, is a financial contract between two parties. Okay, so derivatives are a type of security instrument that are generally publicly traded. So most derivative schedule or most derivative actually security are traded over the counter, no, and personally negotiated transaction between individuals. And this type of sale or trade is largely unregulated this time, no, and there are standardized derivatives traded on a public exchange specialized for derivatives or large public exchanges such as the New York Stock Exchange, Philippine Stock Exchange, and the OTC or the traded over-the-counter derivatives involve much greater risk than the standardized ones because derivatives originated several centuries back. No? Traditionally, while trading across the border, the traders needed to balance the exchange rates as the value of currencies differ from one nation to another. And of course, derivatives were introduced to solve this problem. So depending on the type of derivative, there are several purposes and usage, of course, because derivatives are used for projecting the future price of any asset, avoiding the exchange rate issues, and hedging against changes in asset value. So later on, I will give you a different common types of derivative security, but this time I just want you to watch this video. Again, if you have some inputs or clarification, do not hesitate to post your question in our chat box, okay? So this video actually is very helpful from Corporate Finance Institute, no? Delivered by actually by this company, as I mentioned. This will be actually under CFI Education Inc. No, and this full free course, you will be able actually to earn a certification if you wanted to. No, but I'll just want to play the 6 consecutive videos related on about the forward contracts, no, the introduction of derivatives, and so on and so forth. We started from the very beginning, no, for you to have a totally idea about the derivative securities. Okay. So again, if you have some additional inputs, do not hesitate to post your inputs or additional questions or verification in our chat box.
To this Introduction to Derivatives course. By the end of this course, we'll cover 5 key objectives. You'll be able to, first of all, understand what a derivative contract is. You'll also be able to explain a forward contract and a futures contract, as well as the differences between forward and futures contracts. We'll then move on to understanding options and option contracts, And we'll finish this course by outlining the components of a swap contract. So let's get started. Let's start by asking the question, what is a derivative contract actually? So what is a derivative contract? Well, to understand a derivative contract, we also need to understand more broadly what derivative markets are meant to do. When you hear the term market, what comes to mind? It might be the capital markets, but it could be a flower market or a vegetable market. Markets are used to transfer goods, services, funds, and even risk. When we talk about a derivative market, we're talking about a market that has been developed over time to transfer risk from one party to another. For example, a company may wish to transfer risk related to some foreign currency exposure they have from trading overseas. Or it could be a fund manager who may wish to speculate on the direction of a currency, taking on risks to add returns to their fund. The transfer of risk from one party to another is done often through a derivative contract, which can be seen in simple terms as a bet on which way a particular number, such as the price, may move in the future. A derivative contract derives its value from an underlying instrument, such as a stock price, a currency, or commodity price, such as oil, hence the name derivative. In a derivative contract, two parties will take a stance on the value of the derivative. One side will have the right, generally, to receive payments, while the other will be obligated to make those payments. The size and direction of payments will be based on that underlying instrument. So let's explore the components of a derivative contract. Derivative contracts will generally include these three important components. 1, the underlying asset. 2, whether it's a long or short position. And 3, the expiration date. Let's touch on each of these in turn. Just a word of note here, though. Specific types of derivative contracts will have several other important components other than these three that we'll explore later. Let's start by talking about underlying assets. A derivative contract will derive its value based on the dynamic value of an underlying asset. A few of the most common underlying assets in the derivative markets are stocks, bonds, currencies, commodities, market indexes, or sometimes they're referred to as indices, and interest rates. Next, let's talk about long positions and short positions. In a derivative contract, one party is described as being in a long position while the other is in a short position. If a derivative can be thought of as a bet on a number, then the simplest bet is whether that number is going to rise or fall. A bet that the number is going to rise in the derivative markets is generally described as a long position. For example, a hedge fund manager might bet that the price of gold or the level of the stock market index is going to rise in the next 3 months, and we'd say that hedge fund manager is long gold or long the stock market index. Derivative contracts will also include an expiration date. This is the date when the contract agreement ends, and any differences in the two positions are finally settled. Derivatives will also specify delivery type at expiration where applicable. So, for example, some derivatives will permit physical delivery. This is common with commodity derivatives. Physical delivery means that at the expiration date, the quantity of the underlying asset, it could be gold, it could be oil, it could be corn, specified in the contract will actually be physically delivered to the buyer of the contract. Alternatively, many derivatives permit cash settlement. Cash settled means that the differences in any long or short positions will be settled in cash rather than delivering the underlying asset. Derivative contracts can be entered and traded over the counter, often referred to as OTC, or through exchanges. Over-the-counter or OTC derivatives are customized contracts made through a broker-dealer or directly between two counterparties. Exchange-traded derivatives are standardized contracts that are freely traded on formal organized exchanges such as the Chicago Mercantile Exchange, often called the CME, or the Intercontinental Exchange, commonly referred to as ICE. Derivatives are generally used for two key purposes: hedging and speculating. Hedging involves protecting an underlying position from potential losses. Hedgers typically have an underlying long or short position. So, for example, a public equity portfolio manager who holds a broad portfolio of U.S. stocks has an underlying long position in those stocks. In other words, they win if the price of stocks goes up. However, they may be concerned that the stock market is about to fall. The equity portfolio manager could use a derivative contract to mitigate their underlying position. They could go short an S&P 500 index future such that any gains or losses on their underlying position can be offset by gains or losses on the derivative contract. Derivatives can also be used for speculating, and speculating involves taking a view on the direction of an underlying asset's value with the aim of making a profit. Often, speculating through derivatives is more cost-effective than speculating using the underlying asset. Finally, let's explore the four key derivative categories. Those are forwards, futures, swaps, and options. We're going to cover each of these categories of derivative contracts in turn, starting with forwards. Forwards, futures, and swaps are all deemed to be forward commitments because both parties to the contract are obligated to deliver. Options are often referred to as contingent claims because the contract payout is dependent on a future event. One party to the contract has the opportunity to exercise the option or walk away. And again, we'll explore options in more detail later on.
This will be the continuation.
Category of derivative contracts are forward contracts. So what is a forward contract? Well, a forward contract is simply an agreement between two parties to exchange an asset for a pre-specified agreed price upfront, but on a specific date in the future. Here are a few examples. So, for example, in 1 year's time, maybe party A agrees to purchase 8,000 barrels of oil from a party B at an agreed price now of $50 per barrel, or $40,000 in total. We've locked in a price for the oil now at $50 a barrel, but we won't deliver that oil for a year's time. It could be, for example, in 1 month's time, party A agrees to purchase 500,000 US dollars from party B for 675,000 Canadian dollars. Again, we're locking in an exchange rate now, but the delivery of the currencies will take place in the future, in this case, 1 month. Or, in 5 years' time, party A agrees to purchase 600 troy ounces of gold from party B for 900,000 US. Again, the price is agreed now, $900,000, but the delivery of the gold will be in the future, in this case, 5 years' time. So what is the purpose of a forward contract? Well, as we've already said, forwards are over-the-counter, OTC contracts. Although they can be used for speculating, the customizability of forward contracts makes forwards very useful for hedging. For example, industries that are heavily reliant on commodities, such as an airline, for example, that relies on jet fuel, they can hedge the price of this jet fuel using forwards to reduce volatile prices and match exactly the amount of fuel they intend to buy over a period of months and years. When we talk about the components of a forward contract, there are 5 important components. 1, the underlying asset, whether that be a commodity, a stock, an interest rate, or a currency. The expiration date, when will the commodity, for example, be delivered? The price that we're going to agree upfront, as we saw in our 3 examples. The quantity, and the neat thing about a forward contract is the quantity can be tailored to the 2 parties. Futures contracts have standardized quantities and standardized expiration dates, whereas an OTC forward contract can be tailored between the 2 parties to match the exact quantity that the 2 parties want to trade. And then 5th, there's the type of delivery. And we've talked about this already. Typically, when we hear type of delivery, it's whether the derivative will be physically settled or cash settled. Let's now look at forward contract profit and loss diagrams. On the left, you see the profit and loss or payoff diagram for a long position in a forward contract. And on the right, you see the profit and loss or payoff diagram for a forward contract short position. Let's talk through the diagram on the left with an example. So let's imagine you are buying oil and you've agreed to lock in the price of a barrel of oil now at $50 a barrel for delivery in 1 year's time. So remember, you're buying the oil. Now let's fast forward a year. We now are coming to the end of the contract, the expiration, and now we're going to buy the oil for $50 a barrel. However, the spot price of oil at the time, this is 1 year in the future, let's say is now $55. We've now made a profit of $5 on each barrel of oil because we're buying the oil at our locked-in price of $50, whereas if we had to buy that oil in the spot market, we'd be paying $55 a barrel. So let's get into a worked example in even more detail, and we'll stick with the oil example. So let's consider a situation involving a forward contract, and if you can read the following scenario with me, that would be great. Let's imagine a party needs 10,000 barrels of oil, not in a year, but in 3 months. They're worried about the price of oil rising, so they enter into a forward contract to purchase those 10,000 barrels at $50 a barrel, but for delivery in 3 months' time. At expiration, like the example I've just mentioned, the spot price of oil has risen to $55 a barrel. How much money was saved from entering into the forward contract? And think about, what if the spot price had instead dropped to 40? Before I move on to the answer, I'm going to pause to let you think about the 2 scenarios. Okay, so here we have the question. What I built is a small model in Excel that highlights the 2 scenarios that were just presented. But instead of focusing on those 2 scenarios, I'm going to focus on drawing a payoff or profit and loss diagram for this feature. And we're going to use and build a table starting in row 23. Just a quick reminder, in good models, we always have our inputs in blue font. Any number here that is not a blue font means it's a formula. So if you look in any one of these cells that is black or has black font, you'll see a formula. Just another quick reminder, if you want to format cells, so for example, we see it's $50 a barrel, you can do that quickly by selecting the cell you want to format and hitting Control 1. Choosing Custom Format, and then in the Type window, enter the format that you want to have. So I'm not going to focus much on this table, which are the 2 scenarios that are directly related to the question. I'm going to actually use these inputs. So in row 18, I've created a small table with 3 inputs that I'm going to use to build a bigger table that we can then turn into a graph. So the settlement price is the spot price, and I'm going to start here, and I've already formatted this cell as an input. And I'm going to start by putting a 0 here, but you'll see as soon as I hit enter, not only is it in blue, but it's $0 a barrel because I formatted that cell already. using Control 1 format cell. I'm then going to actually say, what would the difference be in terms of profit and loss for different settlement prices? And my settlement price increment I've put in as an input in cell C21. And it's an input purposely so that I can later change it. If I want to see increments of $10, $20, I can change that. The graph will automatically change because the table will automatically change. For now, what I'm going to do is I'm just going to say in cell B25 that it equals B24 plus the settlement price increment, but I need to lock that down, the referencing I mean. So I'm going to hit F4 so the dollar signs appear. But I'm not going to copy down yet. I'm going to wait. I'm going to go across in this model, and then I'll copy everything down. The next cell is how much are we buying? What's the quantity? And that is in cell C20. I'm going to lock that down again by hitting the F4 key, so I get dollar signs. I'm going to copy that down just one cell, so we have rows 24, 25, done. The cost with the contract is basically saying if we exercise the contract, how much we're going to pay. Well, we know we're going to pay $50 a barrel. I'm going to lock that down with my F4 key and times how many barrels, which is the 10,000 barrels. And I'll copy that down one. I'm using the Control D function to copy down. The cost without the contract is really what would we pay for the barrels of oil if we just had to pay the spot price. So in this case, we're going to link the settlement price, which is the spot price, times the quantity. And I'm just going to copy that down one, Control D. And last but not least, we need to know our profit and loss in each scenario. So in the first scenario, we could have bought the contract if theoretically anyway, the spot price of oil was $0. We would actually have been better off not having the contract. So we're at a loss. So the way we're going to put this into cell F24 is we're going to say the cost without the contract minus the cost with the contract because we know it's a loss. And I'll copy that down one. Now, the reason I've gone across is now that I've done all the columns that I want to, I can highlight one whole row, in this case, row 25, and I can just copy this down. I'm going to copy it down to here. Maybe one more down to, and that quickly fills the table. And it gives me more than the two scenarios that were initially introduced. But why have I done this? So that then I can create a graph. And to speed things up, I've already have the graph prepared, and it's pulling the data in the table that we just created. Congratulations, you have a go, but you have just made a profit and loss diagram for a futures contract. Now let's look at they're standardized. They also trade on derivatives exchanges like the CME or ICE. Futures contracts also involve depositing something called an initial margin that we'll explore in more detail. Finally, futures contracts are marked to market daily, which can lead to margin calls, and we'll explain that as well. So let's get going. Futures contracts, like forwards, can be used for hedging. However, futures contracts are often more attractive for speculating than forwards, and it's because of two key characteristics of a futures contract. First of all, futures contracts offer liquidity because they're traded on exchanges. Futures contracts also have leverage through margins, which we'll explore later. Futures contracts have several key components. First of all, the contract needs to stipulate the underlying asset, whether that be a stock index, a commodity, a currency, and so on. A futures contract will also have an expiration date, often quoted in months. We will need to agree the specified price up front, just like a forward contract. The contract size will be standardized. So contracts for oil, for example, are standardized at 1,000 barrels per contract. Futures contracts also need to stipulate the type of delivery, whether that be physical delivery or cash settled. There's also something called the tick size, which is the minimum increments that the price will move by. And again, we'll see that in more detail a bit later on. And finally, we've mentioned margin several times, and a futures contract will stipulate both something called an initial margin and a maintenance margin. Similar to a forward contract, a long position in a futures contract benefits the higher the price of the underlying asset, whereas a short position on a futures contract will benefit from a lower price of the underlying asset. If we look at the profit and loss diagram for a long position on the left, we see that it matches in many ways the underlying asset price. As the underlying asset price goes up, so does the profit associated with the futures contract. Now let's look at a real futures contract. This futures contract is for gold. We'll start by looking at the delivery date. That, in this case, says Feb 20 or February 2020. This is the date in the future that the transaction will occur. Next, let's look at the contract size. In this case, each contract is for 100 troy ounces of gold. So you can't buy 1 ounce of gold in the futures market. You have to buy increments of 100 troy ounces. Next, we can look at the tick size. The tick size is the minimum price fluctuation per troy ounce. For this gold contract, the price moves in increments of 10 cents. As the contract is for 100 troy ounces, the minimum price fluctuation per contract is 100 troy ounces times 10 cents or $10. Next, you'll see the price. This is the agreed futures contract price. Gold is quoted per troy ounce, so the contract value is $1,518.80, but times 100 troy ounces. So the true contract value is actually $151,880. At the very bottom of the Bloomberg screen, you'll see the margin requirements, and you'll see both something called an initial margin and a secondary margin. The initial margin is the amount of money that needs to be deposited with the exchange to open a buy or sell position on a futures contract. And we'll explore more about margins later in this course. A major difference between forwards and futures is that futures contracts are settled daily. A counterparty's margin account is credited or debited as the spot price of the underlying asset changes. If, for example, the margin account of the buyer or seller falls below a certain point, known as the minimum required margin or secondary margin, a margin call will happen. The counterparty is required to then deposit more money into the margin account to retain their position. And we'll work through an example so you know exactly how margin accounts work in practice. We're going to calculate together the margin requirements for the following contract. We're going to assume we're looking at an oil futures contract that's going to be delivered 3 days from now. The futures price in the contract is $50 per barrel, and the contract size is 1,000 barrels. Now, at the bottom of the screen, you'll see that we're actually going to be trading 10 contracts, so in fact 10,000 barrels, but each contract is for 1,000 barrels. The tick size is 1 cent, which means that the price of oil on this futures contract will move in increments of 1 cent. However, because we're always trading in increments of 1,000 barrels, a change of 1 cent per barrel actually translates to a change of $10 per contract. Because this is a commodity future, the delivery will be physical. We'll actually physically deliver the oil. Now, we want to focus on the margins. there are two margins listed here, an initial margin and a maintenance margin, sometimes referred to as a secondary margin. So what do these really mean? So I'm going to use a bank account analogy first before we move on and do some detailed calculations. So if you want to think about a bank account, the initial margin would be the amount that the bank says you have to deposit just to open a new account. In this case, for the futures contract, then what we're saying is to open the futures contract, the counterparties have to deposit $5,000 each per contract with the exchange. So because there are 10 contracts, each counterparty needs to deposit with the exchange $50,000. The maintenance margin here is $3,000. You can think of a maintenance margin like the minimum balance you need to keep in a bank account. So in our scenario, we are saying to open the futures contract, you need to deposit $5,000 per contract with the exchange. However, you also need to make sure that the minimum balance in the margin account with the exchange never drops below $3,000. If the margin account does drop below $3,000, the counterparty will be asked for a margin call. Let's look at this now in more detail. Okay, so let's look at this in a bit more detail, and then we're going to move to Excel and build a small working model that actually calculates the margins for us. The exposure for both counterparties on the contract is $500,000. We get that by taking the futures contract price of $50 a barrel times 1,000 barrels per contract and then multiply that by 10 contracts. The tick value, which we've already talked about, is 1 cent per barrel, but we also know that each contract is 1,000 barrels, which means the value of the contract moves in increments of $10. But because we have 10 contracts, really the value of our contracts is moving in increments of $100. Now let's remind ourselves of the margins. Each counterparty will need to deposit with the exchange $5,000 per contract. But because there are 10 contracts, the counterparties need to deposit $50,000 each with the exchange. Each counterparty also needs to make sure that their margin account at the exchange never drops below $30,000. That's $3,000 per contract times 10 contracts. Now that we have confirmed the fundamentals, let's look at how this works in practice. In a moment, we'll be doing this in Excel, but for now, I want to highlight just a couple of things. First of all, we're going to assume that the price at the end of each day moves as follows. We start the contract, the day the contract was signed, let's just assume that the price of a barrel of oil was $50. But then at the end of day one, the price went up to $51.10. At the end of day two, the price dropped to $47.50. And then on day three, the day that the contract is delivered and the contract expires, the price of oil moves to $50.20. Instead of talking to the numbers here, let's now move to Excel and we'll build a small working model. Okay, let's calculate margins by building a small model that will calculate whether there will be a margin call. This contract is for 3 days, and the prices are captured here in row 26. Just a quick reminder, everything that's blue font is an input, and everything that's in black font is a formula. So I've already also calculated the daily price movements in row 27. And I've also entered where our margin account starts, and that's the initial margin, which is deposited with the exchange, which is $5,000 per contract times 10 contracts. Next, I'm going to calculate the number of ticks that the price has moved each day. We do this by taking the price movement and just dividing it by the tick size, which is 1 cent a barrel. That gives me 110 ticks. Now, because I want to copy this across, what I'm going to do is I'm going to lock cell C21 with dollar signs, and then I'm going to copy this across. Knowing the number of ticks allows us to quickly calculate changes in our profit and loss. Because if we know the number of ticks, in this case, it went in our favor, we just take the number of ticks times the tick value per contract, which is C22, and I'll lock it down with dollar signs, times the number of contracts, which is 10, which is C15, and I'll lock that down with dollar signs. That's $11,000, and I'll copy that across. So what will happen on day one is $11,000 will be deposited into our margin account. So we'll have our opening balance of $50,000 plus what is being deposited or withdrawn from our account. In this case, $61,000. The next thing we need to do is calculate whether there will be a margin call, and we'll use an if statement. And what we want to do is type something like this, equals if this amount, in this case 61,000, is less than the minimum maintenance margin, which is 30,000, but I need to lock that down, then we're going to get a margin call. And the margin call is going to be, what's the amount that we need to deposit to go back up to the original initial margin of $50,000? So it's going to be, what's the 50,000, which is C19, I'm going to put a dollar sign around that, minus what the amount is before the margin call, which is C31. And we want to put another comma there, because if the margin account is higher than the 30,000, then there's no margin call. I'm going to copy that across in a moment, but we know there will be no margin call here because, of course, the margin account is not below 30,000. In fact, it's gone up. So in cell C33, I'm just going to add total before margin call with the margin. I'm then going to highlight the deposited amount, which in this case was the original 50,000. And that allows me to calculate my profit and loss at the end of the day. I just take the ending margin account minus what I originally had in the margin account. Now let's do day two. Day two, we start in the margin account with 61,000. So I'm going to link that to day one. But then we're going to have 36,000 withdrawn from our margin account. So that's going to be the 61,000, and I'm just going to put a plus sign plus what has changed. And that means we only have 25,000 left in the margin account. We know, therefore, that we have to deposit another 25,000 to bring us back to the initial margin. I'm going to copy my formula across. There's the 25,000. That means that we'll now end up back with the 50,000. What we deposited, though, now is the 50,000 plus another 25,000. And if we copy the formula in cell C35 across, you can see we're now sitting on a loss of 25,000. Finally, we can go to day three. Day three opening balance is going to be the balance or the ending balance from the day before. The total before the margin call is going to be the 50,000 plus 27,000. I'm just going to copy that across. So now we're sitting at 77,000. There won't be a margin call. We'll copy the formula, make sure that says 0, which is telling us that the formula is working. Our ending margin account, we can copy across as well. That's what will be at our end of day. How much was deposited? Well, what was deposited? We don't have any extra margins, so what was deposited is 75,000. And our profit and loss at the end will be 2,000. How are futures prices calculated? Well, let's work through an example. Imagine that you plan to buy 1,000 barrels of oil in 1 year's time. That's when you actually need the oil. There are two strategies you could consider. Strategy one would involve you buying the oil now, even though you don't need it now, and then storing it for a year until you need it. The costs associated with this strategy would be, first of all, we need to borrow money to buy the 1,000 barrels of oil. And we also will need to pay interest on that loan, and we'll also have to pay storage costs. So we can think of the cost of this strategy as the spot price, the price of a barrel of oil, plus two carry costs. We have the cost of interest on the loan, plus we have storage or warehousing costs. For some futures, there can be an underlying asset that provides a carry return. So the formula you see here is the full formula, the spot price plus the carry cost minus the carry return. An example of a carry return on a buy and hold strategy would be a bond. If you held a bond for a year, you would be entitled to a coupon or interest payment. You would have a cash flow coming in. That's an example of carry return. For our 1,000 barrels of oil, however, we only have carry costs and the spot price. The other strategy would be to simply buy a futures contract for 1,000 barrels of oil that actually expires in 1 year's time or matures. The cost in this scenario would simply be the cost of the futures contract. Let's put some numbers to our example. Let's start by assuming that the spot price of oil is $50 a barrel. The cost of borrowing is 5%, and the cost of storing 1,000 barrels of oil is $2,000. Let's also assume a 1-year futures contract is priced at $55 a barrel, or $55,000 per contract. Let's look at these two strategies. So strategy 1 is to buy now and hold. So the cost associated with this strategy is the spot price, which is $50 a barrel times 1,000 barrels, plus a loan of $50,000 or $50 times 1,000, but also times the 5%. We also have to add the storage costs of $2,000, but as already mentioned, there's no carry return, so we'll just put a 0 there. The cost of this strategy is therefore $54,500. Strategy 2 is more straightforward. It just entails buying a futures contract, and the cost will be the futures contract price, in this case, $55,000. If this were the case of strategy 1 and strategy 2, what could an investor do to profit from the situation? If the spot price and futures price are not in equilibrium, there's an arbitrage opportunity. We could execute strategy 1, which is to buy now and hold, and we know the cost of that strategy. We've calculated the cost at $54,500. At the same time, though, we could enter into a futures contract. We wouldn't buy a futures contract, we'd sell a futures contract, which would give us cash of $55,000. Taking the cash from selling the futures contract of $55,000 and minus our cost of strategy 1 of $54,500 leaves us with a profit of $500. Let's look at options. So what is an option? Simply put, an option contract gives one party the right but not the obligation to buy or sell an underlying asset at a specific price by or at a specific date. If the party that has this right to buy or sell chooses to exercise their right or option, the counterparty to the contract must deliver. The two basic option types are a call option and a put option. A call option is the option to buy an underlying asset at a specified price in the future, whereas a put option is the option to sell an underlying asset at a specified price in the future. What is the purpose of an option? Well, options can be used for a wide range of hedging and speculating purposes. Since options give the right but not the obligation to exercise, investors who buy options can use these options to speculate while also reducing downside losses. We can also combine options together, combining calls and puts in many different ways to execute unique strategies that we'll look at later. Let's look at examples of both types of options. We'll start with the call option. In this example, we're going to assume the holder of the option has the right to buy 1,000 barrels of oil at $50 per barrel in 1 year's time. Let's now fast forward a year and let's assume that the spot price of oil is $55 per barrel. Then the holder of the option would exercise the option because the choice the holder has is to buy in the spot market at $55 a barrel, when under the call option contract they can buy at $50 per barrel. If the price in the spot market a year from now was lower than $50, the holder of the option would not exercise the call option. Now let's look at the put option. Let's assume the put option gives the holder of the option the right to sell 600 troy ounces of gold for $1,500 per troy ounce in 6 months. In this scenario, if the price of troy ounces was higher than $1,500, you would not exercise the option because you could sell your gold in the spot market at more than $1,500. However, if the price of gold per ounce was lower than $1,500 per ounce, then you would exercise this option because you would be selling at a higher price, in this case, $1,500 per troy ounce. Important components of an option include the following. First of all, we'll need to understand what is the underlying asset. It could be a commodity like gold, or it could be an equity, a share. Secondly, we need to know the expiration date. Next, we need to know the strike price. We also need to know the contract size. So, for example, the majority of stock options come in contract sizes of 100 shares per contract. We also need to know the type of delivery. Is it physical delivery or cash settled? An important component of an option is also its premium. How much is this option going to cost? We also need to know the type of option. Two common types of options are American options and European options, and we'll explore these in more detail over the next few slides. Let's look at a real call option example. Here we have a Bloomberg screen. The call option is on IBM shares, IBM being a US-based company. In the top right of the screen, you'll see the underlying IBM share price or stock price, which is 143.575. Near the top left, you'll see the call option ticker. IBM, the first few letters of the ticker, highlight the underlying asset and that it is a US equity. Next, we have the expiration date, which is January 17th, 2020. This is followed by the letter C, which stands for call option, and then the 140 represents the strike price. The strike price is the price at which the option can be exercised. So in this case, the holder of the IBM call option has the right, but not the obligation, to buy IBM stock at $140 per share. Next, we have the exercise type. This call option is an American option. There are many types of options. Two common types of options are American options and European options. An American option can be exercised over a period until the expiration date, whereas a European option can only be exercised on the expiration date. Next, we have the contract size. This call option requires the holder of the call option to buy 100 IBM shares, not one share. Finally, I want to highlight the delta on this screen. Delta is the relationship between an options price and the price of the underlying asset, in this case, IBM stock. A delta of 0.598 means that if the stock price of IBM goes up by $1, the option price will rise by 59.8 cents. Now let's look at a put option, real example. We're looking at an equity put option for the same company, IBM. We'll start by going to the top right-hand corner, and you can still see the price, the underlying price of the IBM shares when this Bloomberg screen was taken was $143.54. We then can turn to the ticker. Here the ticker looks very similar to the one before. The only difference is the C has been replaced by a P, with the P representing a put option. We've left the strike price at 140, but in this case, the holder of the option has the right to sell IBM stock for $140 per share. Again, it's an American option, which means that the holder of this option can exercise their option through the period until the expiration date, which is 17 January 2020. The final thing we see here is the delta. And what's different with this delta is that it has a negative sign in front, and that's because it is a put option. The delta, recall, is the relationship between an options price and the price of the underlying IBM stock. A delta of negative 0.413 means that if the stock price goes up by $1, the option price is going to fall by 41.3 cents. Here we can see the profit and loss or payoff diagrams for a long position and a short position related to a call option. The owner of the option or holder of the option, we say, is long that option. So in this case, they would be long a call option. The profit and loss or payoff diagram for this position is on the left. Where the blue horizontal and vertical lines cross is neither a profit or a loss. It's zero. Anything above the line is a profit. Anything below that line is a loss. The K that you see on the graph stands for the strike price. So let's imagine that we're talking about oil, and the strike price of oil is $50. That's where the K would be. Now, let's also assume that the option costs the holder $1. If the option is not exercised, which is where the graph starts, the holder of the option will be sitting on a small loss, the loss being the cost of the option, or $1. However, as the stock price goes up and beats the strike price, so let's imagine that the stock price of oil goes to $55, well, then the option will be exercised because the option allows the holder to exercise at $50, which means they'd make a gain of $5. However, their net profit and loss would only be $5 because the cost of the option was $1. On the right, we have a short call position. You'll see that it is inverted, or in some ways is a mirror image of the long call position. If the strike price, which we said for oil was going to be $50, is below $50, the option will not be exercised. That means the short position, or the writer of the option, walks away with a small profit, which is the premium of $1. However, as the spot price of oil goes up, let's say it goes up to $55, the short position will start losing money. At $55, recall that the long option holder is going to exercise that option and therefore have a profit of $4. For the short call position, that means they'll have a loss of $4. They have to sell the stock for $50, buy it at $55, losing $5, but they offset that loss of $5 with a $1 premium. Here we can see the profit and loss or payoff diagrams for a long position and a short position on a put option. The long put position is someone who has bought the option, and it's the right to sell shares or the underlying asset. In our example, let's assume it's a long put on oil. So the holder of the put option, the long put position, has the right to sell oil for, let's say, a strike price, which is represented by the K, of $50. Let's now imagine that the price of oil in the spot market is $55. The holder of the put option will not exercise their right to sell at $50 because they could sell in the spot market at $55. So they'll be sitting on a small loss, that loss being the cost of the premium, which we can say, for example, is $1. However, if the price of oil in the spot market drops to, let's say, $45, then the long put position will actually exercise the option and therefore will have a profit. So the option holder has the right to sell oil at $50 a barrel when in the spot market it is selling at $45. So there's a gain of $5. However, we have to offset the cost of the premium, which would mean that the long put position is sitting on a profit of $4. A profit of $4 for the long position means the short put position must be making a loss of $4. Let's pause to talk about a term called moneyness. Moneyness refers to whether an option has intrinsic value at a point in time by comparing simply the strike price with the underlying spot price. Here we have a call option payoff or profit and loss diagram. If for a call option, the spot price is greater than the strike price, we say that the option is in the money. You may see the initials ITM for short. If, for a call option, the strike and spot prices are the same, we say that option is at the money, or ATM. And if the spot price is below the strike price for a call option, we say that is out of the money, or OTM. We'd use the same terms for a put option, however, the reverse would hold. If the strike price was higher than the spot price for a put option, that would be in the money. And if the spot price was higher than the strike price for a put option, then we'd say that was out of the money.
Okay, so actually there's certain continuation, no, for the derivatives also.
Let's work through an example using a put option.
Another
An
example.
investor holds 100 shares of Company A, which is currently trading at $50 per share. And let's assume they believe that the stock price will fall soon. So to hedge this risk, they decide to purchase 100 put options on Company A shares. These put options will assume have a strike price of $45 per share and a premium of $2 per share. The question is, what is the investor's profit or loss in each of three scenarios? Scenario 1 is assume that the stock price falls to $45. In scenario 2, we'll assume the stock price falls to $40. And in scenario 3, we'll assume the stock price falls to 0. The table shows the three scenarios where the spot price drops from $50 to $45, to $40, and to 0. Recall that the put option premium is $2 per share. So for 100 shares, that works out to $200. And the original spot price is $50 per share, and the strike price is $45 per share. So in scenario 1, we're saying that the spot prices drop from $50 to $45. We therefore have a loss on the underlying stock of $5 per share, multiplied by 100 shares gives us a loss of $500. We also have that cash outflow of $200 related to the premium. In this scenario, the spot price equals the strike price of $45, so the put option isn't exercised. The investor, therefore, is sitting on a net loss of $700. Now let's turn to scenario 2. Here we have the price of the underlying shares dropping from $50 per share to $40 per share. That's a loss of $10 per share times the 100 shares, which gives us an underlying loss on the stock of $1,000. We paid the premium of $200, but in this instance, it's in the interest of the holder of the option to exercise that option. The investor has a right to sell the shares at $45 per share, which is a gain of $5 per share times the 100 shares, which equates to a gain of $500. The three items together net out to a net loss for the investor of $700. Now let's do an extreme situation where the spot price drops to 0. Here the loss on the underlying stock would be $5,000. It would be $50 per share times 100 shares. We have the premium loss, but then we would have a gain on the put options of $4,500, which means our net loss still works out to a loss of $700. Okay, now let's build a profit and loss or payoff diagram in Excel. We're going to use the following inputs that are in the small table that has Scenario 1, Scenario 2, and Scenario 3. Recall that blue font represents an input, a black font represents a formula or a link to another cell. So we're going to start with opening price. Opening price is the same as starting price, and I'm going to link that to an input cell, which is C11, and I'll use F4 to lock down both the row and the column reference. I'm just going to copy that down so we have a few of them. Our closing price is going to be an input column, so this will be in blue font, and I want the closing price to be in increments of $5. So I'm going to type in 0, but just to speed things up, I'm going to link the next one to the previous, which is 0, and add 5, and then I can copy this down. And we'll make that go up to 100 eventually. The next is quantity. We are going to make sure we link this to the table above. It's going to be black font because it's not going to be an input, and the quantity of shares is in C12. We want to lock the referencing again, so we'll put F4 to get the dollar signs. We'll copy that down just to make sure that the reference is working. The strike price will be the same. We'll link it to the input, which is in blue font. We'll put dollar signs in and copy it down just to make sure, again, it is not using relative referencing. And now we can calculate the underlying gains or losses on the underlying stock, then the premium, and then the gain or loss on the actual option. So we're going to put an equal sign here and a bracket, and what we're saying is that the closing price is 0 and the opening price was 50, we're losing $50 a share. So the formula will be C24 minus B24, but recall it's times 100 shares, and we should get negative 5,000. The cost of premium, I'll put an equal sign here. We're going to put a negative though, because it's a cash outflow, is going to be $2 per share, but then times 100 shares. And I'm going to link it to the quantity there. And that should work out to minus 200. Now I'll copy these both down just to make sure, again, they're working. And I'm going to look at the last one. So what we have is if the price was $30 as a closing price, that would be a loss of $20 per share times 100. So that's a loss of 2,000, and our premium is staying at 200, which is correct. Next, I need to look at my gain or loss on the actual put option. We'll need to use an if function here because the option will be exercised or not exercised depending on where the closing price is relative to the strike price. So I'm going to put an equal sign and go if. And what we're going to say is if the closing price is greater than the strike price, we know the put option won't be exercised. So we'll put a 0 there. However, if the close price is below the strike price, then we will exercise that option and we'll get a gain. So we're going to put a bracket here, and we're going to take the strike price and minus the closing price. We're going to multiply that by the number of shares. And if we've done this right, it should be a positive, and it should be 4,500. I'll copy that down. Now what we can do is just net off the last 3 columns. So it's F24 plus G24 plus H24, and we can copy that down. Now I want this to go up to 100, so I'm going to scroll down all the way down to row 44, and I'm going to go Control D to fill down the entire table. And it looks like our table is working. Now that we've done the table, it's often useful to use conditional formatting, and in this case, what I'd like to do is use conditional formatting to show me the maximum loss. We can see the maximum loss here in column I is 700, but I want to visually highlight the maximum loss we can make. So I'm going to highlight this whole column, and I'm going to the conditional formatting menu, and I'm going to create a new rule. And I'm going to select the one that says use a formula to determine which cells to format. And I'm going to enter this formula. We're going to say if I-24 equals the smallest number, which is min, and I'm going to highlight the cells there. And then put a bracket. The formula that I've written here is look at the cell and see if it's the smallest number in that column. And if so, format it. And we're going to format it with a fill. And I'm just going to make it a slight orange. I'm going to click OK. And let's see if the formatting works. Click OK. Now you can see something's gone wrong because they've all gone orange. And it's to do with how those dollar signs appeared on the I-24. So let's go back to conditional formatting. And we're going to go to Manage Rules. And we're going to edit the rule. And what we're going to do is we're going to change this formula slightly. We're going to take the dollar sign out of the 24, but keep the dollar sign with the I, and then click OK. Then we're going to apply it, and you can see now the formula is working. It's highlighting in this column our maximum loss, which is really the $700.
Okay, this will be the last video for this discussion.
Now let's turn our attention to swap contracts. Let's start by asking the question, what is a swap contract? Well, a swap contract is a derivative in which two counterparties exchange cash flows, which we often call legs, over a period of time. Often, one leg will be a fixed payment, while the other will be a floating payment. Here we have an example, a visual example of a swap, where two counterparties are swapping three payments. The floating leg is represented by the wavy line. The fixed leg is represented by the straight line. One payment will be swapped on January 1st, 2020, the next one 6 months later, with the final one on the maturity date being the expiration of the swap. Let's look at some of the aspects of a swap contract in more detail. There are typically 6 major components to a swap contract. First of all, we need to understand what the underlying asset is. It could be, for example, a fixed coupon bond, a floating rate note, or an equity. Next, we need to know the notional amount. The notional amount is not normally paid or received by the counterparties. Instead, it is used to calculate the cash flows that will be swapped. Next, we need to know the maturity date. The maturity date outlines the period over which cash flows will be swapped. It can be anything from 2 years to 10 years. Next, we need to know the fixed and floating rates. The fixed rate will be set at the start of the swap, and it will remain fixed for the entire term to maturity. The floating rate, well, for an interest rate swap, for example, it will normally be based on 3-month, 6-month, maybe 12-month LIBOR, dependent on the frequency of the payments. Lastly, we need to know the payment frequency. Payments, for example, on an interest rate swap are typically made either quarterly, semi-annually, or annually. The most widely traded swap contracts in the financial markets are plain vanilla interest rate swaps. An interest rate swap swaps a fixed rate of interest for a floating rate of interest. Two counterparties enter into an interest rate swap with one counterparty paying fixed while the other counterparty pays floating. The amount of these payments will be calculated using fixed and floating interest rates and a notional amount, let's say $100 million, that is not swapped. Interest rate swaps are often done to take advantage of different comparative borrowing rate advantages of the two counterparties. Let's now add some numbers to the previous example to see how this works. Let's imagine Company A and Company B agree to swap fixed for floating interest rates on a notional value of $1 million. Let's assume the term of the interest rate swap is 2 years, with interest payments being swapped every 6 months. The fixed rate will be set at the start of the swap, and that's set at 5.25%. Let's also imagine that the floating rates on the swap, assuming we're looking back, are now they're set at 5% for 6 months, but in 6 months from now, that will increase to 5.2%. In 12 months from now, it will be 5.3%. And in 18 months from now, the 6-month LIBOR will be 5.4%. We'll build a small table now in Excel. Let's build a table that shows the payments on an interest rate swap. Our inputs are in blue font. The notional amount of the swap is $1 million. The fixed leg is 5.25%. We're going to pay the fixed leg of interest every 6 months, so I've put here twice a year. The floating leg is based on LIBOR, and the floating leg payment frequency is also every 6 months, which is why I've put a 2. In practice, it's quite common for the fixed leg of an interest rate swap to be every 6 months, whereas the floating leg is every 3 months, so we'd enter the number 4 here instead of 2. We're also going to assume that 6-month LIBOR starts at 5%, but every 6 months is changing. Now in practice, we would only know these rates at the end of the swap or as we approach the following 6 months, but let's just assume those are the LIBOR rates over the swap. We're going to start by working on the fixed leg, starting in row 25, then we'll move to the floating leg, and then we'll talk about the payments, because payments between the two counterparties will always be netted off. So we talk about the loan value of $1 million being the notional amount, so it won't be swapped. In practice, it's not swapped because what we do is take the loan value, which is $1 million, and the loan value on the other side, which is $1 million, and swapping them, and I'm just going to take one minus the other, is going to just lead to 0. At the end of the swap, it would be like we are swapping the loans back. So I'm going to just do Control C and V. The mistake I made here was I forgot to lock down my referencing. So I'm just going to hit the dollar signs with F4, get those dollar signs in there with F4, and then I'll recopy that. So academically, we can argue that one counterparty is swapping a loan for another loan, but in practice, those loan amounts, because the notional amount is always set to be the same, are going to cancel each other out, and no money related to the underlying is going to be transferred. Now in 6 months, we know that the fixed leg needs to pay interest rate at 5.25%. So here's our 5.25%. And I'm going to lock that down by hitting F4. However, that is an annual rate, and it's also referred to as a nominal rate. So to get the 6-month rate, we only have to divide it by the payment frequency, which in this case is 2. And that's C13, and I'll lock that down. But then we need to multiply it by the underlying notional amount, which is $1 million, and that's C11. And again, I'll put dollar signs there to lock it down. And I'll copy that down. And you can see each payment for the fixed leg is going to be $26,250. Now let's look at the floating leg. The floating leg, the interest rate is going to change. So we're going to go, it's going to start at 5%. But we also know that the payment frequency is every 6 months. So we're going to divide that by 2. I'm not going to lock down the C18 because I want that cell to move, but I do want to lock down the C15 with dollar signs so that one doesn't move. And I also need to multiply it by the notional amount, which again, I need to put dollar signs there because I don't want it to move. And I'm going to copy this down. And all I need to do now is look at the differences between the two. And it's the net payments that will be exchanged between the two counterparties. We're going to finish this Introduction to Derivatives course by looking at one more interest rate swap example so that we can see the benefits to both counterparties of entering into an interest rate swap. So let's say that two companies can borrow at the following rates. Company A can borrow fixed at 5% and floating at LIBOR, whereas Company B can borrow at 6% fixed or LIBOR plus 50 basis points floating. Before we continue, just make a note that you can see that Company A can borrow fixed and floating more cheaply than Company B. The key thing also, though, to note is that Company A can borrow fixed at 100 basis points or 1% less than Company B, whereas for floating, Company A can borrow at only 50 basis points less than Company B. We also want to assume that Company A wants to borrow at a floating rate and Company B wants to borrow at a fixed rate. The question is, how can we set up an interest rate swap so that it is mutually beneficial to both parties? We've already mentioned that Company A has a comparative advantage against Company B's borrowing rates, both fixed and floating. So because of that, and because the differential is slightly different, 100 basis points on the fixed and 50 basis points on the floating, we can arrange a mutually beneficial swap. First, we're going to get Company A to borrow at their lower fixed rate of 5%, whereas Company B will borrow at their floating rate, which you may recall is LIBOR plus 50 basis points. Company A will then pay Company B LIBOR on a predetermined notional amount, and Company B will pay Company A a fixed rate. And let's just say it's 5.25% on that same predetermined notional amount. In effect, Company A and B will each reduce their cost of borrowing by 25 basis points. Let's look at this in a bit more detail. So let's start with Company A. Recall that Company A's initial borrowing cost is 5%, but it actually wants to pay LIBOR. What it receives on the swap is 5.25%. So its net borrowing cost is ultimately LIBOR minus 25 basis points. So Company A is saving 25 basis points. Now let's look at Company B. Recall that Company B's original borrowing costs are LIBOR plus 50 basis points, however they want to pay fixed, and they're paying 5.25%. They'll receive from Company A LIBOR, and when we net all of this out, what we're left with is that Company B can borrow at 5.75% when the original borrowing cost was 6%. So Company B also saves 25 basis points. That brings us to the end of this Introduction to Derivatives course. We look forward to seeing you on more capital markets courses. Bye for now.
Okay, so actually, as what our video presented, we need to consider some common types of derivative security, no? And number one, of course, is the currency future, no? So suppose, no, let's say, for example, Juan, a Filipino investor buys stock at let's say an American company using US dollar, and now Juan would be in at risk of exchange rates while holding that share. So Juan can avoid the risk by purchasing currency futures, no, a derivative security. It would fix the exchange rate for selling the share in future and converting the money to the Philippine peso, no. Then another, of course, as what our video, no, mentioned, that the future contract, no, one party agrees to sell an asset to the other on a fixed price within a, let's say, for example, in June 2017. So let's say he signed a future contract with Miss Joaquin, let's say for example, to avoid the risk of the stock of that company declining. So Miss let's say for example Joaquin agreed to buy a stock after 1 year. So it's speculating a rise in the price of that company stock. Now, if the price rise according to the speculation in June 2017, so Miss Joaquin makes a profit out of it. And if the price drops, so of course, Mr. Juan gets extra bucks by selling it in a price higher than the pricing market. And that is the future contract. The forward contracts, as what our video also discussed, these are basically the same as future contract, but it is only traded over the counter and not on exchange. For the options, options are similar contract. So the difference with future contract is here the parties have the right to buy or call option or sell put option an asset on a fixed price on or before a future date, but they are not obligated. So here the transaction is optional and not mandatory for option. The last one, as what our video presented, is swap. A swap is most commonly used for trading loan terms. Here the two parties signing the contract agree to swap their loan terms. Interest rate swap is where one goes from fixed interest rate loan to variable interest rate loan on the opposite. So someone with a fixed interest rate loan signs to contract with some having a variable interest rate loan. So where other loan terms are similar. So the loan will be in the original borrower's name, but both the parties are obligated to make the payment towards the other loans according to the agreement. So take note that a mortgage-backed security, yung MBS, securitizing a group of underlying mortgage debt, because the MBS or the mortgage-backed security represent ownership of an underlying asset, and the assets are securitized, and the securitized is not a derivative. Okay, so again, it is important to us to understand this purely because the discount for lack of marketability, often called a liquidity discount, is a fixed amount of percentage deducted from the selling price or a block of share markets that lack marketability. And these are the closely held restricted share that cannot be resold in the market easily. So I think that's it for this topic. Okay.